The end of the Australian financial year is right around the corner, so what should we be doing? That's exactly what we're going to check into in this video, and I'll share with you exactly what I do as the end of the Australian financial year approaches and what you should be considering. Let's dive in. Hi there, Jared Brown here, Australian Expat Financial Planner here in Singapore. Welcome to my video series. In this video, we're going to be looking at some end of financial year tips, and I'm going to share with you exactly what I do when it comes to end of financial year planning for my Australian assets. Now, for anybody who's not already aware, the Australian financial year is the 1st of July to the 30th of June. So when it comes to the end of financial year planning, both personally and with our clients, we like to start planning at the beginning of May at the very latest. It gives us a couple of months to manage any cash flows, transferring cash, transferring assets, contributing to super, whatever else it may be, gives us a bit of peace of mind so that we're not leaving it to the last minute. So in this video, I'll share with you the steps that I take to essentially minimize any tax exposure in Australia and manage my portfolio effectively. So let's have a look. So when it comes to the end of financial year, the first thing that I do is I reach out to my property managers in Australia for the investment properties that I own, and I ask for a summary. So financial year to date is the summary that I want. So from the 1st of July last year to the current date now. So we're currently in May 2023. So I want the summary from 1 July to May 2023. Now, often your property manager will respond with something unhelpful like, we usually send these reports out in July after the end of financial year, and your response can be, just like mine is, that is of no use to me. I need my end of financial year summary now, and I understand that it will not reflect the May and the June cash flows. Based on the 10 months that I'm provided with, I can very easily estimate what the final 2 months are going to look like. So that property management report will give me a summary of the rental income that I've earned and the expenses that I've incurred. So that's step one. Step two is I log into my internet banking and I download the interest summaries of the investment loans associated with those investment properties. Now, remember, it is only the interest that is deductible, so I'm only really interested in the interest that I have repaid off those loan balances over the financial year. So I've got my net rental income, I've now got my interest. The final step is to review any other expenses that I incurred with those investment properties that the property manager may not have captured. So personally, I repainted one of my investment properties in Australia. That wasn't captured by the property manager in their report simply because of how we manage the invoicing. So instead, I add that expense on to give me my net position. So I've got my net rental income, I've taken off the interest that I have paid, I've taken off the additional expense, which in this case was repainting to bring it up to the original condition, and now I have my net taxable income in Australia. So the final step is, what do I do to get rid of this tax liability in Australia? And that's what we'll share with you next. So the final step, now that I know my net taxable income position for the financial year, now again, we are extrapolating the final 2 months of the financial year. It does not need to be exact, it just needs to be close. So now that I have my number, let's just say for this example that figure is $10,000 worth of taxable income. Now, if I do nothing, I'm going to pay 32.5% or $3,250 to the Australian Tax Office for the privilege, which I do not want to do. So instead, I have two options. I can prepay some of the interest on my investment loans for up to the next 12 months, or I can contribute that money into my superannuation fund. Now, personally, I like to review both. I do have a bit of a preference towards superannuation. I like adding to my retirement nest egg, particularly given I'm relatively young, i.e. not 10 years off accessing my super. So I've got plenty of time to boost that balance for the following years. So what I then do is I contribute that $10,000 into my Australian superannuation fund. I'm going to fill out a form to claim the deduction. So that is my intent to claim a tax deduction on that contribution. I make sure my super fund deducts the tax and treats it as a concessional contribution. They are going to deduct 15% contributions tax off that contribution. So the $10,000 that I put in, I will see $8,500 invested, and I will claim that $10,000 off my taxable income. Now my taxable income position is now zero. So I managed to boost my super, pay a little bit of tax on the way in, but avoided paying that 32.5% tax that I otherwise would have had to do. So that's what I do personally. It is certainly the time of the financial year to start reviewing your own options. Don't pay tax that you don't need to, and have a look at what is right for you. I hope that gives you a bit of food for thought, some ideas to plan for, given the end of financial year is rapidly approaching. Drop me a note with any questions you've got, but thank you very much for tuning in.